ITR Economics. Thank you for joining us for this edition of FedWatch. Today is October 27th, 2023, and the focus of today is going to be the quote-unquote sizzling hot third quarter GDP number and what that might mean for Fed action down the road. And it was a bigger number than even we had anticipated, and it came in 1.3% above our average forecast, so the midpoint of our forecast range for the quarter. So it was on the good side, no doubt about it. But we refrain from calling that sizzling hot for a whole host of reasons. One of which is that the number one driver of the surge, quote unquote, in GDP for the quarter was personal consumption expenditures for household services and utilities, which simply meant that it costs more to pay the utilities, pay the rent, and otherwise take care of the home. And that obviously means money flowing into somebody else's pocket, hence the increase in GDP. But it also means that the consumer, therefore, didn't have as much money to spend on stuff. And given the tightness of the savings numbers, I think that's important. So when they characterize this as pushed upward by very strong consumer activity, when you peel away a layer or two, it's not as robust as one would think. The second largest component for GDP growth was an increase in non-farm inventories. And you know how GDP is calculated. I understand that that's a plus for GDP. But from a business person's perspective, when we're not out there buying a lot of stuff and inventories are going up, and they're going up for forklift operators to a whole host of people up and down that supply chain, that's not a good sign. That means there's a slowdown coming. To that effect, by the way, one of the glaring negatives in the GDP report, from my perspective, was that business fixed investment in capital equipment was down. It was a draw down on GDP. So inventories are up and businesses aren't investing in capital equipment. That's not a really encouraging sign going forward. Third largest component was personal consumption expenditures for durable goods. And I was cross-referencing that non-durable goods consumer new orders is actually in negative territory, running below year-ago levels. It's the durable goods side of things that is strong. And the strongest part of that was automobiles, running about 16.8% ahead of the year-ago third quarter. So a very strong, robust part of where people were indeed spending their money. And then after that, you get into is the federal government coming on strong, spending money both on consumption items and on national defense. And then it was state and local governments. I mean, that rounds out the top five of why GDP went up. And really it was the number three thing, consumer durables, that was the bright spot as far as we were concerned. It was not that large of an increase outside of those automobiles. So that got me looking at, well, what is retail sales doing, in this post-COVID world? It's kind of hard to measure. So we looked at different slices of retail sales compared to the pre-COVID 10-year average. And even e-commerce, which is still one of the darling parts of the economy, is up 7.7% on a 3/12 basis for the third quarter of 2023. But the pre-COVID 10-year growth rate is 14.7% per annum. So we're essentially running at half the speed that we did before. Total retail sales, and this is all in inflated dollars, by the way. Pre-COVID, 4.3% growth rate. Last 3 months, the third quarter, was up only 2.9%. So, and that's with inflation baked into those retail sales numbers. So my point here is, don't buy into the consumer sizzling hot interpretation of the data. It's just not happening. Which brings me to the FedWatch point, is how this is crucial. We had Jerome Powell saying that they're going to take the long view and probably hold interest rates steady, but there's still some hawks on the FOMC. And they're going to look at this data and say, look, you see, it's still too strong. We need to push rates up one more time. Whether they do or don't, it's not going to make or break the economy at this point. They've already done the damage with the rate increases that we've already seen. But it is time for them to stop raising interest rates. We need them to come to a point in their minds where they say, okay, stop raising interest rates, live with that for some period of time. And that gets them into the mindset that when the weak data starts coming out, more obviously 1Q 2024, they're in a better mindset to not reverse course, but simply bend the course toward getting us some interest rate decline. And don't forget, we only need 50, 75 bips of short-term interest rate decline for the yield curve to normalize. And when we looked at all the inverse yield curves in the past, you don't get an economy really going again until you see that trend normalize. And so it has to normalize one way or the other. Either long bonds are going to go up even higher in terms of the yields, or short's going to come down, or some combination of the two. But that combination is pleasantly narrow at, well, it's 68 basis points as of yesterday's close. So it's doable. First, they need to stop, and they need to tear apart the GDP numbers like we just did for you. So I'm glad it was up, but it wasn't the torrid pace that you may be given that impression of. Thank you for watching this edition of Fed Watch. We expect the Fed is going to lean toward raising rates, but if I had to bet on it, I would bet that they're going to hold fast because enough of the other data is not looking good. Some of the earlier gains that we've seen in housing, for instance, have begun to dissipate again. Thank you for watching this edition of Fed Watch. It's been a pleasure. I am on PTO vacation next week. I'm going to be away from the camera. So I will see you in 2 weeks. Thank you.